Hello, I'm Nathan Kubik, and thank you for joining us for the Carnegie and Kubik second quarter of 2017 Capital Markets Outlook. Today we'll be discussing what we're observing in the financial markets, as well as what we recognize as the most noteworthy influencing factors. After discussion on potential impacts of those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. This quarter, we observed many of the same themes we discussed at the end of last quarter. We will once again focus on the areas we identify as risks and the areas that we recognize as opportunities. The discussion of over or undervaluations will once more be front and center as we discuss economics, world dynamics, style, and sector weightings, as well as the current interest rate environment. The U.S. economy has continued to advance, albeit at a slower pace than we might prefer. Additionally, from a global standpoint, the U.S. continues to look relatively attractive. That said, there are a number of domestic initiatives that have the opportunity to be a catalyst or an inhibitor in what happens next. Globally, there are growing concerns over North Korea. The instability in the Middle East continues to be ever present. And domestically, infrastructure spending and tax reform have taken a back seat to healthcare and financial regulatory reform. Financial regulatory reform is moving along with the House passing adjustments to Dodd-Frank. Additionally, the Treasury Department has weighed in and is in favor of some of these adjustments. The Federal Reserve has just determined that every bank has passed its stress tests. Healthcare reform, on the other hand, has been met with some resistance on both sides of the aisle. The primary reason this hasn't been able to move through Congress is political, and it seems clear that the midterm elections are going to be an influencing factor. From our perspective, what happens with healthcare reform will be an indicator of what will occur with a number of other legislative initiatives. For example, the future of tax reform is somewhat dependent on what occurs with this reform. The explanation for this dependency is in part due to the effectiveness of the current administration, but also the potential for reduced spending in the healthcare space through reform. Looking at the chart on the left, we see that the U.S. is expected to spend approximately $4 trillion in 2017. With only $3.3 trillion in financing or income, we are running at a deficit. With the majority of our income coming from taxes, it would be careless to simply pass a tax cut without a corresponding reduction in our spending. Without doing so, we would simply increase our deficit spending and increase our debt levels at an even more rapid pace. And with our economic growth being relatively slow right now, it's unreasonable to assume that we'd be able to grow our way out of this deficit. Thus, if we intend to cut the revenue side of the equation through reduced taxes, the only physically responsible thing for us to do would be to cut spending too. We are hopeful that our leaders can balance our country's budget with a thoughtful approach that will allow for continued economic strength, growth, and stability. From the perspective of the equity markets, investors are clearly of the mind that our government will be successful in doing just that. Sentiment indicators remain at higher levels, and the S&P 500 grew another 2.7% in the second quarter, making the year-to-date performance 8.2%. The underlying companies of the S&P 500 appear to have had another positive quarter, and as a result, valuation levels remain very similar to that of last quarter. The moderate overvaluation of the equity markets is still present, but style valuations moved into a more historically normative relationship. In observing this chart, we're considering the historical forward price-to-earnings ratio compared with that of today's levels. The chart does imply that the S&P 500 is a bit overvalued. Looking at other valuation metrics like price-to-sales or price-to-cash flow, we come to similar conclusions. However, from a price-to-book or earnings yield spread standpoint, the markets appear to be appropriately or slightly undervalued. From Carnegie and Kubik's perspective, we would say that for the first time in quite a while, we are a bit overvalued from a historical valuation perspective. There are still areas of the equity markets that we feel offer good buying opportunities, and given the U.S.'s relative economic strength, we believe that this valuation premium is still justifiable. We do not yet believe that we are in a danger zone from a valuation perspective. However, the significance of intrinsic valuation methodology and fundamental analysis in our underlying holdings is now even more critical function. From a corporate strength perspective, companies are continuing to grow stronger every quarter. Looking at the chart on the left, we see a large upwards trend in earnings per share since the recession that occurred nearly 10 years ago. The dip you see in 2014 was primarily a result of falling oil prices and the corresponding impact on the earnings of those energy companies. And remember that almost every other sector was still increasing earnings during this same time period. Balance sheets have continued to improve, with cash balances growing as a percentage of corporations' current assets. Companies are continuing to increase their dividends per share, which tells us that they feel strongly about their balance sheets. They are also continuing to purchase shares of their own stock, which tells us they feel strongly about the valuations of their stocks. I should note that with the higher valuations we are seeing today, the total number of share buybacks has declined slightly. But this makes sense when you consider that while the equity markets as a whole are slightly overvalued, there are specific stocks that are more dramatically overvalued, and those companies are less likely to purchase shares at those levels. Generally, it is the companies that believe they are undervalued that will typically buy back their shares. To that end, share buybacks as a whole are still at very high historical levels. In addition to strong financials for corporations, the average American is also stronger financially. Additionally, Americans feel confident in the economy, as seen in the sentiment chart on the left. Household debt service ratios are at record lows, with total debt payments averaging about 10% of their disposable income. Also, total household net worth has continued to climb at an impressive rate. An interesting consideration is the plausible inference that people are saving more, and perhaps not spending as much. If true, this would potentially have a couple implications. The first is a short-term implication. The lower spending could be contributing to the slower growth we are seeing economically. The second is a longer-term implication. Perhaps this added savings implies that the average person is thinking about the future, retirement, and planning ahead. Whether or not these implications are long-term trends, what we do know is that the average person is now more financially stable than they have been historically. Helping achieve that greater household wealth number is the performance in the equity markets. We have been in a bull market for quite some time now, and from a performance standpoint, it doesn't appear to be slowing down. That said, the markets will always experience pullbacks, and these are generally unforeseeable. Looking at the chart on the right, you will see the calendar year returns denoted by the gray bars and the intra-year declines as red dots. Most years experience a double-digit decline at some point throughout the year. When valuations get a little long in the tooth, the likelihood of a pullback can increase slightly. That said, it's also a possibility that we could keep climbing from here without a pullback for some time. This is one of the reasons that underlying security valuations is even more critical today than it has been in recent years. Another interesting chart is that on the left. This chart shows how looking myopically at the markets can paint very different pictures over different time periods. Considering only the last 1 year return, you'd see performance significantly better than the historical average. Looking at the past 10 years' performance against the historical average, you'd see a lot of underperformance. The point is that historical performance is not necessarily an indicator of what comes next, and why it isn't critical to take a comprehensive look at the markets as a whole. In doing so, we recognize that different market cycles have very different characteristics. Different styles and sectors perform better or worse in different environments. As in the first half of the year, we have seen large growth companies continue to lead in performance, moving the long-term trend back to its pre-election quarter path. As we discussed last quarter, there were a number of reasons that growth stocks appeared better positioned than that of value stocks, including market momentum, historical relative valuations, underlying sector exposures, and the specific market cycle that we appear to be in. 3 of those reasons have not changed, but one has become somewhat less directive. For a number of years, large growth companies have looked more attractive from a historical price-to-earnings valuation standpoint than that of value companies. However, with the recent outperformance in growth stocks, the relationship between value and growth has moved to a more historically normative level. Remember that this chart is based on a 15-year historical time period, and that we believe these historical average price-to-earnings ratios are not necessarily the best targets. But what we do find to be quite important is the relationship depicted here between value and growth companies. In 2017, our core equity model has been overweight in growth, and we do see reasons to believe that this trend will continue. However, with valuation levels now in parity, we will need less of a nudge from economic indicators to move back towards a neutral weighting, should there appear to be signs of a style shift. Additionally, underlying security valuations and sector and some sector exposures are increasingly important from a risk perspective. As you might expect, three of the top four performing sectors for the first half of 2017 were the growth-oriented sectors of technology, consumer discretionaries, and industrials. Healthcare was the second best performing sector, which denotes the likelihood of it bottoming after falling out of favor a bit over a year ago. Energy continues to struggle with oil pricing uncertainties. The value-oriented sectors of consumer staples, utilities, and financials also took strides forward this year, just not quite as strongly as that of the growth sectors. On this slide, we look at the weights of the sectors comprising the S&P 500 and that of our core equity model. Our largest target overweight has been in the technology space. As we have mentioned in the past, this sector has seemed to have the most wind behind its sails. We do believe that some of that wind has subsided as a result of its strong outperformance, and in the last month of the quarter, it did give back some of those gains. We do still believe that the sector as a whole remains attractive. Valuations are still lower than historical averages, and our market cycle analysis indicates that this sector should continue to perform. We have had a slight overweight in financials as a result of the universally expected adjustments to Dodd-Frank. We are also targeting a slight overweight to healthcare and industrials. We are currently in the process of reducing some of our consumer discretionary holdings, and with the exception of Amazon, we have minimized our retail subsector exposures. Our significant areas of underweighting as a result of excessive valuations include real estate and utilities. We are also underweight telecom for other reasons. While we feel strongly about our current positionings, we are ready to make any necessary adjustments as new data and opportunities become present. We continue to have limited exposure to the international equity markets, with about 5% of our core equity model invested in international, multinational companies. The gray line here is the S&P 500, and the purple line is the All-Company World Index, not including the U.S. Clearly, the U.S. equity markets have significantly outperformed the global market since the recession. However, we did see some momentum pick up in some European zones over the past few months, but we are not yet ready to call that a trend or add additional exposure there. This is something we are monitoring closely in order to determine if additional exposure is warranted. Having discussed the high level of investor confidence and continued rise in the equity markets, you might expect the yields of safer, income-producing securities to increase, and the prices to fall a bit as a result of lower demand. In actuality, this is a very interesting dichotomy, as the equity markets and fixed income markets are telling us two different things. The equity markets are telling us that everything is great. The economy is going to pick up speed, companies are going to increase their financial strength, and the equity markets are going to keep rising. The bond markets, on the other hand, are telling us that there might be cause for concern. In the past, we have discussed many of the influencing factors that have led us to why we are in this low interest rate environment, and most of those items really have not changed. One piece that does have the potential to shift the relationship is the Federal Reserve's plan to sell their fixed income holdings, currently on their balance sheet. The next page shows us a graph of what is currently expected. Back in 2008, the Fed began its quantitative easing strategies to facilitate growth and accelerate our economic recovery. QE2 started in 2010 and QE3 in 2012. Each of these easings resulted in the Federal Reserve's balance sheet growing through the purchase of Treasury bonds, mortgage-backed securities, and other fixed income securities. The Federal Reserve has since been transparent in its plans to unload its balance sheet by selling these securities into the markets. The big takeaway here is threefold. First, the Fed feels confident in our economy and feels that it is now strong enough to absorb these securities. Second, unwinding these holdings will offer the Fed another arrow in its quiver should a future quantitative easing be needed. Third, when the Fed starts selling these securities, this will increase the supply of bond availability. Assuming demand remains constant, this does have the potential for prices of bonds to decrease slightly and for interest rates to rise. Whether or not that is a reality is yet to be seen. However, should this occur, we would want to take advantage of this buying opportunity and extend some of the durations in our clients' portfolios. In conclusion, while we do believe that some areas in the markets are overvalued from a historical perspective, we do feel good about where we are economically and where we believe we are headed. We believe the U.S. markets continue to be growing faster and stronger than the rest of the world, and because of that, believe they can demand a bit of a market premium. That said, given the current state of the markets, the factors of fundamental intrinsic valuation analysis are increasingly important, and that avoiding excessively overvalued areas of the market is critical. We are continuing to position our portfolios in efforts to reduce downside risk exposures while maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please know just how much that means to all of us. Please reach out to us if we can provide you with any additional information or clarity on any of the information presented. Take care, and we look forward to speaking with you soon.